Hey, what is up everybody? It's Shaun here, and if you've been following the stock market lately, then you know it's been an absolute bloodbath. We have gotten to the worst start in stock markets since 2008, and we haven't seen this drastic or dramatic of a drop since the beginning of the pandemic in March of 2020. Now, in terms of index funds, the Dow is down 4.6%, the S&P 500 is down about 5.7%, and the NASDAQ is down 14% since its previous all-time highs in November. Now, if you're an individual stock investor, it's also been really terrible. Just this last week, Netflix dropped 20%, having its worst day since July of 2012. And if you're invested in Peloton, it's dropped over 70% of its value just in the last 3 months alone. Now, for those of you who are cryptocurrency investors, we've also seen a massive bloodbath. Just recently, crypto has lost over $400 billion in its overall market capitalization, with Bitcoin dropping over 30%. It has reached its most oversold point since the pandemic of March 2020. And altcoins such as Ethereum and other altcoins have lost 30, 40+% in the recent days or weeks. So the reason I wanted to make this video is because a lot of people that probably watch my channel or that are in the markets right now are probably entering a phase that they've never experienced before. Because let's face it, over the last few years, the markets have been really, really awesome. And if you've been investing in almost anything, you've been seeing some awesome returns. Yes, there's been some dips along the way, but it's been pretty simple. When you see a dip, buy the dip, and within a few days or a few weeks, you're going to be up and be profiting more than ever before. But the question becomes, what happens when you buy the dip?
And then it dips again, and then it dips again, and eventually you're out of money or you've lost most of your money and you're in a state of panic because you don't know what's going to be happening.
Are we going into a recession? Is this going to continue for much longer? So what I want to talk about in today's video is why has this all happened? What can we expect in the near future? And how you should be navigating this so that you can capitalize the best that you can. So this brings me to my very first point, which is the monetary policy from the Federal Reserve. Now, over the last few years, we've had some historic lows in interest rates. Over 80% of all US money that's circulating right now was printed in just the last 22 months alone. Because we've had such historic low interest rates and the fact we've had so much more money circulating, this has created the perfect environment for riskier investing. So a lot of studies show that when you have low interest rates and lots of money available, people will tend investing a lot more money than they normally would, and also in riskier investments for higher returns overall. Bringing me to my second point, which is overall inflation. We've had the absolute perfect storm from very low interest rates to excessive amount of money printing to the fact we've had supply and demand issues due to COVID. We've had some insanely high inflation rates that we haven't seen in the last 40 years. The US economy has not seen inflation rates over 5% since the 1980s, where it peaked at 14% with double-digit unemployment rates. This kind of inflation amplifies stock valuations, it amplifies cost of goods, and it also amplifies the amount of risk that people are willing to take. Now, while having some inflation can be great for people who are invested in assets like real estate and stocks, cryptocurrencies, and the likes, having too much inflation is actually a bad thing for the overall economy. As inflation continues to increase, you're going to see a lot higher cost of goods. The problem is that if the cost of goods rise too much, the average person is no longer able to afford the cost of goods, or they're not able to keep up or budget appropriately. It also is not good for companies because as inflation kicks in, if it kicks in too high, what you're going to see is an overall production cost going up and also labor costs going up. And to combat that, companies are either going to have to push the overall cost onto the consumer, or they're going to have to reduce overall production or labor in general. Now, if this high level of inflation continues to go unchecked, what will happen is you will create an environment called hyperinflation. And hyperinflation really is just when inflation begins to snowball on itself, creating a level of really unprecedented inflation. If hyperinflation gets extreme enough, like in the case of the late 2000s with Zimbabwe, the value of the currency can essentially plummet to almost zero. Now, while I don't think the US is going to be experiencing this hyperinflation where the US dollar goes to absolute zero, this does bring me to my next point. Point number 3 is increasing the overall interest rates. So one of the best ways of combating inflation is to begin raising interest rates, which the Federal Reserve has stated that they're going to be doing over this next year, anywhere between 1 to 3 times, maybe even more than that. Also comes with its own set of problems. Typically, as interest rates begin to rise, you start to see a reduction in the amount of risk that people are willing to take in their overall investments. And this is why we're starting to see a massive sell-off in things like growth stocks, tech stocks, cryptocurrencies, and the likes, because they are riskier, higher reward investments. Because the Federal Reserve hasn't stated how many times specifically they're going to raise interest rates, and they also haven't stated exactly how much they're going to be raising interest rates, Better to take the profit now and wait than to be stuck holding the bag. Now this brings me to my fourth point, which is just slowing growth overall. Over the last couple years in 2020 and 2021, we've seen some massive growth in overall sales in different sectors despite the fact that we're in the midst of a pandemic. But that overall growth is starting to decline, and we're starting to see that with companies like Netflix, who recently reported a slowdown in their overall growth. This causing their stock to plummet over 20% overnight. Other companies like Peloton have also reported a massive drop-off in overall demand, once again causing their stocks to plummet 70% over the last 3 months alone. And I think we're going to continue to see this as companies begin to report slower growth rates. A lot of people are going to get nervous about this and begin exiting their positions in these stocks. And the reason for this overall slowdown in growth rate is pretty simple. You see, over the last few years, we've had a massive increase in overall money circulation, and people have been spending their money on things like subscriptions, on Peloton bikes, and making their overall larger purchases. Thus meaning that the demand for overall purchases in general are starting to decline. Not to mention that we're starting to see again that over half of Americans can't even afford a $1,000 emergency expense. So how do we navigate from here? Because that really is the big question. Well, first and foremost, I do think that this period of time really does show the importance of making sure that no matter how amazing stock markets look, no matter how frothy that they get, it's really, really important to make sure that you always have a small emergency fund behind you for periods like this where we may have to wait out for a little bit of period of time. Now, in terms of how long this is going to last or if it's going to get any worse before it gets better, I don't know if anyone can say that with 100% certainty. But there are some things we can be certain of, and that is the long-term future. So let's take a look. If you look at the S&P 500, for instance, which has dropped, about 5.7% recently, which may feel like a really massive dip and a pretty big hit to your overall portfolio. If you look at the overall history of that fund, you're gonna find that that 5 to 6% drop really is so insignificant compared to the overall growth it's had since the inception. Not to mention that this drop is a lot less than when looking at the 2000 dot-com bubble and also the 2008 financial crisis. So even though this is a very emotional and scary time, what we do know is that this is also a really great time to begin loading up on those investments. So let's talk about how we navigate from here. So whether or not it continues to dip a little bit further, what we do know is that it always recovers and goes even higher than it did previously. So what I would be doing right now is I would be making sure that I cut back on as many expenses as I can. If you haven't done so already, make sure you have a really good emergency fund put away, maybe 3 to 6 month emergency fund, just in case you have to hold out for a little bit of time. From there, I'd be putting at least 10 to 20% of my savings into investments moving forward. Now, if you're wanting the absolute safest bet, you want to stick with something like an S&P 500 index fund, which I talk a lot about on my channel. Statistically, you're going to have a 94 to 96% chance of beating individual stock pickers and hedge fund managers over a 15+ year period of time. Now, if you're wanting to play a little more risk, you could start investing in some individual stocks at this time. But if you're going to do that, I would stick with companies that are very big companies that have a really good track record and companies that you know should be around for a very long period moving forward. And for those of you who can stomach the volatility or are okay with holding on for a long period of time, you could also begin putting like 1 to 5% or more of your portfolio into things like cryptocurrency. Now, when it comes to cryptocurrency, I would say you want to stick with the blue chip coins, things like Bitcoin and Ethereum. They have the highest likelihood of being relevant and staying with us for the longest period of time. It's important to remember that anything that you invest in, if you're not willing to invest for at least 10 years, you shouldn't invest for 10 minutes. But also keep in mind that true wealth is built during recessions, and that recessions create the most amount of wealth long term. So this is a fantastic time to begin buying. The hardest part is keeping our emotions in check, making sure you don't panic sell. And remember, you don't actually lose money until you actually sell. Create a game plan for the near immediate future, because we don't know if it's going to go down or go up from this point. But what we do know is that over time, it's going to have some massive growth rate, and this is the time to begin capitalizing and really buying in on as many investments as you can to create that foundation to build more wealth in the future. Now, if this video gave you some value, please be sure to smash the like button, hit the subscribe button as well as that little notification bell if you haven't done so already. If you're all about money, investing, entrepreneurship, then this is the channel for you. So be sure to check those out. But let's get out there and let's build that dream.